All right, welcome back to another edition of Financial Accounting. So we are here Wednesday, March 17th. Happy St. Patty's Day, everybody. Be safe out there. We have no homework due tomorrow. We will be talking about 7.3 today, no 7.4. 7.4, we'll just start that on Monday when we come back from spring break. So there's no class at all on Friday, no homework this Thursday. So after class today, consider yourselves of having a 4-day weekend ish. Be safe out there, like I said. When we come back, realize we are just going to keep plowing ahead through the chapters. So our next exam is on Friday, April 2nd, and April 20th is the date where the extra credit is due. So the extra credit project, which is worth 20 points. If you get 95% of this project correct, you get 20 points. You must score at least 70 points to get any credit at all. The rest of the homeworks for chapters 7 through 8 are available on my accounting lab. Without any further ado, let's talk about 7.3. 7.3 is a bit of a beast, which is why we're going to dedicate entire class time today to talk about this material. Recall that plant assets, the word plant assets implies or is synonymous with fixed assets, tangible assets, property, plant, equipment. Basically, we're just talking about long-term assets that we use several periods in the future. The concept that is typically associated with long-term assets is depreciation. Now, depreciation by itself, essentially in accounting, means a process. It's a process of allocating the cost of the asset to expenses over its life. So we don't expense the cost of a building or equipment right away. We expense it little by little as we use it over time. Depreciation, the word depreciation is synonymous with reduction or a decrease. So when we're talking about depreciation of PP&E, we're talking about a reduction of PP&E value because of its use. And obviously it's the opposite of appreciation. Why do property, plant, and equipment asset values decrease or depreciate? Well, primarily because they wear out over time or potentially they become obsolete. So their values depreciate as we use them or just as time passes. For example, your car depreciates as it's being used. So the more miles you click on the odometer, the more the excuse me, the more your car value depreciates. But there's also a function of time. As time goes by, the car becomes less and less valuable. Primarily, you could say due to obsolescence, but really has to be really old to be completely obsolete. One exception is when regard to depreciation is that land is not depreciated. So make sure you pay attention to that when you're going through your homework. We don't depreciate land. Land primarily from an economic point of view or even a market point of view appreciates in value, increases over time. So generally speaking, we don't depreciate land because its value doesn't go away. It can only go higher and higher and higher. Also keep in mind this too, like a building can be demolished, equipment can be destroyed, but land is there forever, pretty much for the most part, right? And God ain't making any more of it. So bottom line is we don't depreciate land because it doesn't go away. How do we recognize depreciation? Well, we use the expense recognition principle to help guide us in recognizing depreciation. So since fixed assets help generate revenue, we must recognize or match depreciation expense against that revenue. Depreciation expense is the amount of the PP&E value that we're consuming. So depreciation is the process of reducing the value. Depreciation expense is the recognition of the value that has been consumed and therefore is expense on the income statement. When we report depreciation, realize we've got the income statement where we show all of our expenses. So we'll see an amount for depreciation expense on the income statement, which represents a portion of the value that has been consumed for a particular year. So remember, income statements are just a period of time that reports the revenues and expenses for primarily a year. So when we look at depreciation expense, we can say, oh, this is how much value we consumed of our property, plant, equipment. On the balance sheet, we don't really report, you don't really see the current year's amount consumed. What you see on the balance sheet is cost of the asset and its accumulated depreciation basically the total value of depreciation taken to date. So that's what we see is essentially a net book value. When you subtract accumulated depreciation from cost, you get net book value. That's what we're interested in showing on the balance sheet, not how much depreciation expense has occurred, but how much value is left over, the remaining value left over to use and benefit from in future periods. Accumulated depreciation simply keeps track of how much value we have consumed of those assets. We keep track of those separately, and we'll explain why here in a little bit. Accumulated depreciation, historical depreciation expense, is a record of how much we've taken to date. It's like a bucket. Okay, each year's depreciation expense is thrown in. So in 2018, if we bought equipment in the beginning of 2018 and we depreciate it during that first year of 100, that goes into the debit is depreciation expense, the credit is accumulated depreciation. Next year we start fresh with new expenses, so we have another 100, and the year after that another 100. These just keep going into the accumulated depreciation account to keep track of an historical record of how much depreciation we've taken to date, which essentially means how much wear and tear, theoretical wear and tear, we have recognized to date. So that's interesting to be able to see that in a separate account, the theoretical amount of wear and tear on the property, plant, and equipment. Why do we bother expensing these things? I mean, we know the value decreases, right? Well, here's the thing, kind of harkening back to the expense recognition principle. Assets are resources that help us generate revenues, right? We need resources to help us, say, for instance, make pizzas. So pizza oven is something we spend money on so we can start generating revenues, right? We pay employee salaries because they help us make the pizzas and sell the pizzas, right? We got to spend money to make money. So expenses are natural. Expenses naturally follow revenues. So if we have higher revenues, we expect higher expenses. So in the case of when we're talking about expenses, just realize that expenses represent the consumption of assets, those resources that we're using. So like a pizza ovens, we're using those pizza ovens to help generate revenues, make pizzas, generate revenues. So there's got to be some sort of expense or consumption of those pizza ovens. Most assets end up as expenses, right? If we pay cash for employee salaries, that's a direct expense. But inventory ends up as cost of goods sold. When we consume it, we're selling it. Supplies, when we consume those, end up as supplies expense. Prepaid rent, we prepay at the beginning of the period. As we benefit from using it, we eventually recognize that that value has gone away. A building also follows that same suit. Any long-term asset, with the exception of land, follows the same suit, but we don't call it building expense. We call it depreciation expense. We're trying to use somewhat of a general term because to call it building expense essentially implies that it's disappearing, the same way supplies ends up as supplies expense. Buildings don't disappear as we consume its value. So we're going to use a specific term, depreciation expense, to represent the theoretical reduction in value. Depreciation, again, is the process of allocating the fixed asset cost to the expense. The expense itself is the amount that we are calculating to recognize on the income statement. Like inventory, prepaid rent and supplies, a fixed asset starts as an asset, ends up as an expense. It just does so in a slightly different way because we're using accumulated depreciation. That's the contra asset account. In fact, we just make a little note back up here that this accumulated depreciation is a contra asset account. Okay, it's meant to offset the cost basis. So if we have a truck, we're going to have accumulated depreciation for that truck. We have a building, we're going to have accumulated depreciation for that building. It's the contra asset account. Like inventory, prepaid rent, it all starts off as an asset, ends up as an expense. But unlike inventory, prepaid rent, and supplies, the asset's physical existence doesn't disappear or go away. Supplies, as we consume supplies, they disappear, they go away, they're consumed. Prepaid rent, time goes by, those days are gone, that value has disappeared. Inventory, it physically leaves our warehouse, it has disappeared. But a building doesn't disappear. So how do we acknowledge that its value has depreciated? How do we measure that? How do we calculate that? Well, we have a couple different things that we're going to look through here to calculate its theoretical wear and tear. Depreciation expense is a theoretical amount of a reduction in value. It's theoretical. We cannot measure with absolute accuracy how much wear and tear there is on our computer or our car or a building, right? We know that the value is decreasing over time or with use, but we don't know exactly how much depreciation is occurring, because even if we looked at a molecular level, right, what does that really tell us in terms of depreciation? So what we're talking about here with depreciation is we need to make an estimate. And this is kind of where, a lot of people tend to struggle with accounting because we use so many estimates. Well, we have to, because not everything is easily measurable. Like some of the transactions we saw in chapter 3 and 4, those things are pretty easily verifiable, easily measurable. But when it gets to estimates, we know things are happening economically, but there's no real verifiable way. So estimates are happening for us now. To estimate how much we depreciate a fixed asset, we need certain information about the fixed asset. Specifically, we need to know its cost. We need to know how much we paid to get the asset in place and ready to use. So that's going back to 7.1. That 7.1, learning objective 7.1, helps us recall what the known amount is for that cost basis. From there, we need to, once we buy, say, a car or a moving van, we need to make an estimate or a guess of how long we're going to use the machinery or the vehicle or the building, right? And sometimes we can rely on our accountants to come up with some sort of industry estimates or industry expectations or industry norms, trends, or if we've had, like, say, computer systems in the past and they usually work for 3 years and we upgrade it, well, that's historical data that we can use as well. But we have to make a guess once we buy it. We also need to make an estimate of how much we expect to cash out when we sell the asset at the end of its useful life. That's called residual value, right? It's a value we can recuperate, or value we get at end of life when we sell. So if we have computer equipment, we could just toss it, get rid of it, scrap it, make it, basically be worth zero. Or maybe there is somebody who's willing to at least pay us some amount of money, some small amount of money. Maybe we can donate it too and get some sort of benefit from doing that as well. But generally speaking, when it comes down to it, we can toss it, get rid of it, dispose of it in an eco-friendly kind of a way. It doesn't necessarily mean we're always going to have some sort of end value once this thing is done. Most companies like to just assume that the residual value is going to be zero by the end of the useful life. So for example, let's talk about the purchase of a truck. So if we buy a truck, right, with cash, we're going to debit the truck. That's a long-term asset account. And let's assume it's $41,000. Okay, so it goes into the T account. That's the cost, right? All the costs incurred to get it. So that includes things like, registration fees, title, taxes, et cetera, all things about learning objective 7.1. What else do we need to know? What else do we need to get information on? Well, we know what the cost basis is. We need to make a guess on its estimated residual value. So we'll assume that by the time this thing is ready to be turned in, when we have to get a new truck, right? When all is said and done, when we're done using this thing, let's assume we can sell it for $1,000. That means its depreciable cost, otherwise known as depreciable base, is $40,000. That's how much value we're going to consume over its useful life. How long is this thing going to be used? So we're going to use this thing maybe 5 years or 100,000 miles. Okay, we're just going to make some guesses right there. So the cool thing about a truck is you can actually measure how much you're using it by looking at the odometer. So we can take the 40,000 and say we can spread this value of consumption over these different estimations. It's either useful life in years or it's units of production. But this is the total value. That's the total value we will consume over its useful life. We're spending $41,000. We're not expensing this right away, but we expect to expense in total $40,000 over its useful life. But we're going to spread it thinly. So the straight line method of depreciation, this is the most common one, method of determining depreciation expense. There is an equation here. It's rather it looks kind of ugly here, so let's just sort of draw it out visually here. There's the cost, subtract off the residual value. That gives us a depreciable base. We will expense this over 5 years. So basically that means we're going to expense $40,000 of that cost at $8,000 per year. In straight line depreciation, it's nice because it's predictable. It's also the most commonly used method. But it's going to, and the reason why is because it's going to be the same each year. Every year is 8,000, 8,000, 8,000, 8,000. We like that predictability. So year one, what's the first full year's worth of depreciation? Well, we just debit depreciation expense. Sometimes you see depreciation expense with a hyphen, maybe it says truck, but we're not going to reduce the cost account. We're going to set up that accumulated depreciation truck account to record this. Remember, this is all the theoretical. This is theoretical wear and tear. So we don't want to reduce it directly into the truck account because we don't know if it's not like the truck is disappearing. It's still there. It's just worth a little bit less. So the theoretical amount of reduction is going to be captured in a contra asset account. We record that bad boy, and we get at the end of the period an $8,000 accumulated depreciation balance, and we will report a net book value on the balance sheet of $33,000. So that's the cost minus accumulated depreciation gets us net book value right there. So just remember that for the sake of the exam, because there's always going to be questions about these kinds of problems on the exam. What about the next full year's worth of depreciation? Guess what? There's no mystery here. It's still just going to be the $8,000, but this time we can sort of see it's stacking up in the accumulated depreciation account. After 2 years, we have taken we've consumed $16,000 worth of value from the truck. So now how much future value remains? Well, we expect $25,000 worth of future value. Most of that's going to be consumed. The other $1,000 of it we expect to get in cash when we sell it. Let's skip ahead into year 5, the final year. What's the last full year's worth of depreciation? Guess what? It's still $8,000. By the time we do that $8,000 of worth of depreciation, our accumulated depreciation shows that $40,000. That's the depreciable base, mind you. We knew that was going to be $40,000 because we calculated it as such. So we've now consumed the whole 5 years worth of depreciation. So total 5 years worth of depreciation is $40,000. What's the net book value at that point in time? Well, it's just the cost minus accumulated depreciation. So in this case, guess what's left over? It's the $1,000. We have $1,000 of residual value, which is the same thing as the net book value. That's not magical, that's mechanical. We designed it to be this way. We took, $8,000, 1, 2, 3, 4, 5. That's the total amount of value we consumed. This was its original cost. We have $1,000 left over. Hopefully we can sell it for $1,000 and break even. Oftentimes we may have to sell it for a little bit less and take a loss, but we'll talk more about that later on. So key thing to realize is at the end of the useful life, the residual value, the net book value must equal the residual value. If we've done all the calculations correctly, that will be a mathematical certainty. So the straight line method is pretty straightforward, but there's other methods we can use that can be a little bit more accurate because potentially these cars change in value depending on how much we use it. So enter in the units of production method, where we essentially do the same calculation as we saw before, but we're going to be using miles. We're going to spread the $40,000 depreciable base over not 5 years, but 100,000 miles. So as we drive it more, we're going to expense more. That makes a little bit more sense in the case of vehicles because there's no odometer we can rely on there. So we can calculate based on that. There's going to be 40 cents worth of depreciation every time 1 mile clicks in the odometer. And you can see here that each depreciation expense is assigned to each unit of output, and it's going to be the same, 40 cents per mile. But depreciation in total is not necessarily going to be the same each year. We can have some years when it's low, some years when it's high, and maybe as it gets older, we use it less. Who knows, right? So who knows what the pattern is going to be of use? It just depends on the business. So down below, I say, what if we use the truck, drive the truck for 25,000 miles? Well, if you just multiply that 25,000 miles times the 40 cents, that means we've consumed $10,000 worth of value from the vehicle. So our journal entry will just be the $10,000, not 8,000. Here we're actually basing it on how much we're driving the thing. So 10,000 goes in, total of 10,000 accumulated depreciation. So our net book value in this case is a little bit lower than under straight line method because we're driving it more, therefore its value is decreasing faster than under the straight line method. But some years we may drive it less, in which case the depreciation expense might be less than straight line, who knows? But this is more accurate, I would say, than straight line method. So if we can do units of production, we should. What if we drove 14,000 miles in year 2? Well, 14,000 miles, excuse me, not 14,000, 35,000 miles we drive it times 40 cents gets us $14,000. So we just debit the depreciation expense for 14,000. Now we see that, oh, the value, how much we consumed over 2 years is 24,000. Recall at the end of year 2 for straight line, it was like 16, right? So some depreciation methods are more accurate than others. It just sort of depends on which one we prefer to use based on how easy it is to calculate this information. So again, most companies like to use straight line depreciation because it's easier. So 24,000 is the new accumulated depreciation. So now the net book value is down to $17,000. So we have 17,000 future years worth, future economic benefit. We're showing the net book value, meaning we're not directly reducing the cost. We're setting up a contra asset account to calculate those theoretical deductions in value. But the net book value essentially represents how much value is left. Again, we're still assuming $1,000 of residual value there. Each mile driven is the same rate, but the total number of miles driven likely varies. Therefore, depreciation expense is not necessarily the same each year. Let's be aware of that. Last year, assume we have we've driven the thing for 90,000 miles. We're going to drive another 10,000. We're going to say trade it in and get a new truck, right? So drive 10,000 miles, multiply that out, it's $4,000 worth. And we say, good, stop driving the thing. We'll trade it in. How much depreciation have we taken over the 100,000 miles? 40,000. Remember, we're spreading out the depreciable base over 100,000 miles in this case. So we've driven 100,000 miles, so we've consumed all the value that we want. Residual value is the same thing as net book value at the end of the period. That should be the case. Now, someone usually asks me, what if we drove 105,000 miles, right? If we drive 105,000 miles, we can continue to depreciate it, right? But we'll never depreciate below 41,000. Let's see here. Double declining balance method. This one is kind of a beast. Yeah, it's kind of tricky. So it's an accelerated method of depreciating an asset. So what you kind of see over here is the depreciation expense amount per year. And so it kind of, you see it starts really high, then it gets lower and lower and lower. It's higher in the earlier years, right? A larger amount of expense in the start of the asset's life depreciates more value when it's new. Some people say, hey, when an asset is new, it's running the most efficiently as possible. As things get old, they don't run as well. Like your car gets used, it starts to sputter and not be as effective as it used to be. So we'll depreciate a smaller amount towards the end of its life because it's probably not running as well as it used to. The rate of change is exponential. So the key thing here is you want to be able to be comfortable sketching out a chart of depreciation. Chart of depreciation, which we'll see here down below. Give you an example to walk through. You want to get good at writing this stuff out. So assume, double declining, before we get into it here, the double declining essentially means double the straight line depreciation rate. The straight line rate is 1 divided by the useful life in years. So in our case, we have a 5-year useful life. So 1 divided by 5 is 20%. So every year, we're depreciating 20% of the depreciable base. 20% times 2, if we double that, is 40%. That's the key thing you want to be good at calculating, is just the double declining balance rate. And usually on the exam, I think I make it simple. It's either like 10% per year times 2, or in this case, it's 20% each year times 2. So it's going to be usually somewhere between 20% double declining rate or 40% double declining rate. I don't like to get too crazy with these. These are just examples, right? But the most important thing is, how does this thing work? Does the math really play out? Well, you have to be very careful. You have to be very careful. What I recommend you do is sketch out a chart, the chart that you see here down below. Plug in the cost in the top left and plug in the residual value in the bottom right. What you see here is the top left is the beginning net book value. So at the start of the first year, we paid $41,000. We're going to start with cost. We're not going to really worry about residual value calculations yet. Okay. The cost is $41,000, so we start with that first. Then go ahead and plug in the rates except for the last year. Skip that. Okay. Get comfortable setting up this on scratch paper, because in the exam, guarantee you're going to have a double declining balance methodology question that you're just going to have to walk through. There's going to be a depreciation expense, which is based on the beginning net book value times the double declining balance rate. Then you want to figure out what is the ending net book value, which is, again, just cost minus accumulated depreciation. And we'll walk through this step by step. But get some practice setting the sucker up here. Fill out the rest of the chart, left to right, top to bottom. So start by calculating the first year's depreciation expense. So we do 41,000 times 40% equals 16,400. That's the depreciation expense for year one. If we update if we do a calculation for ending net book value, we would see that the cost minus accumulated depreciation is 24,600. What do you do with that balance? You take this sucker and you move it to the next line, the start of the next line. That's your beginning net book value for year two. And you just keep doing this line by line by line until you get to this last row. So you want to be careful. Repeat the process until you reach the last row. Don't make this mistake. This is often a mistake on the exam, is to keep going. You want to stop at year 5. So if we fill this in, if we do the math, which the math isn't too challenging, you do have to scribble some things out, but this is sort of like a simplified chart. Your homework will have you practice filling this sucker out too. So get all the way through. So we go boom, 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 and we get to this last row. So plug the ending net book value from the second to last year, plug that sucker over into year 5. Now, determine the depreciation expense needed. You don't want to multiply it by a rate. What you want to do is compare the ending $1,000 is our residual value with 5314. What do you need for depreciation expense to get a residual value of 1,000? You need 4,314. So this is a plug figure. This is what we call a plug figure. It's just the algebra needed to determine the depreciation expense. All the years prior, we just multiply the beginning net book value times the 40%. But it's that last year that tends to cause people trouble. So this is the residual value, which also equals ending net book value. When all is said and done, the net book value should still be the residual value. If we kept doing this, by the way, if we kept multiplying by 40%, we would never actually reach 1,000. It's an asymptotic curve, which means that it never quite reaches an asymptote, which is in this case $1,000. It will just keep going. You sort of think about the chart, like there's that 1,000, right? If we keep depreciating at 40%, it will never quite touch. Ooh, I touched there. It would never quite touch if we kept using the 40% multiplication. So usually at the end of the 5th year, what we would see is a little bit of a spike upward. So you kind of see going down, they go a little spike upward like that. So just be aware of that. That's a little tricky part of the double declining balance method. DDB, not deaf, dumb, and blind. Double declining balance. Is there a shortcut to filling in the chart? Yes, but I don't recommend you use it. Okay, so you can sort of see a pattern evolve here. The beginning net book value declines 40% each year. So the following year's net book value is 60% of the previous year's net book value. 60% is just the one minus the double declining balance rate. So beginning net book value for year two is 24600. That's just taking the 41,000. Let me use the highlighter here. Take the 41,000 right there, then multiply it by 60%, which is 1 minus the double declining balance rate, right? And that gets you 24,600. And you just keep repeating that process over and over again. Times 60%, get you that. Times 60%, get you that. You can keep doing that all the way down to this last row and realize that the difference in each one of these, the difference is depreciation expense. So yeah, there is a shortcut to doing this. This is depreciation expense, right? These are all just, the differences between those are just the depreciation expense amounts. So there is a shortcut. You can do it that way. If you get comfortable filling out the chart, save some time, skip through it, do it that way. I don't recommend it though, at least when you start studying this stuff. I think you want to work through the chart and get comfortable doing that. How do the different methods compare? Well, if you remember, the straight line method is just boom, boom, boom. It's the same every single year. So what you got is just a straight 8,000, 8,000, 8,000, 8,000. Units of production can vary a lot. So imagine, like, you know, in one year we had 8,000. That's right there. Next year we had 12,000. That's up there. 10, 6, 4. So maybe it sort of declines. Who knows, right? It just depends on how much we use it. In our double declining balance, we started off by having a really high amount in year one and a very low amount. Year two actually kind of goes up like that, and maybe 4,000 right there. But the idea again being that it's going to decline quickly because we get more value from a newer asset than we do from a used asset. So that's how these things compare. Which method should we use? Well, depreciation method should be chosen based on the type of asset being depreciated. So if you got like an odometer type of tracker, right, on your machine, you should use that. So some computers have hours of use or amount of memory consumed in a day, things like that. If your computer system has a tracker of use, that's one way of determining. It'd be good to use the units of production method. Most companies, though, they like to use straight line because it's just easier, right? Because the difference is pretty marginal, insignificant. So it just sort of depends. But these are just some of the different criteria. And I think the most important thing to realize is most companies use straight line. And the reason why is just because it's simple. It's simple and it's predictable, and financial analysts and investors like it, like predictability. They like to know that what next year's expense is going to be for depreciation. They don't want any changes or variability. Double declining balance can be good for tax purposes, though, because if we take a huge tax charge in the earlier years, that means we have less net income, which means less tax, right? So if we get high depreciation expense, that's going to result in low net income, which means low tax. So that might be worthwhile doing. In fact, just to sort of compare the two here, imagine like we kind of went through with the straight line method. We said, here's our $8,000 worth of depreciation expense under the straight line method. There's 16,400 under accelerated. What's the overall effect? Well, we got income before income tax. You can see this is lower, this is higher. So taxes are lower, taxes are higher. If we don't like paying taxes, maybe we want to use the accelerated method here. And so on and so forth. So you can sort of look at this and say that maybe there is a savings of some amount from taxes just based on the difference between these guys here and paying less in taxes. So to compare these two, that's a bad arrow. I can sort of compare these guys, right? I'm saving roughly $2,500 in taxes because I chose an accelerated method. But realize that's just temporary, right? If you do an overlap of the expenses, realize that that tax benefit, if this is straight line and this is the double declining balance, right? DDB, deaf, dumb, and blind, right? There's tax benefit up till you get to this point. there's your tax benefit because higher expenses. But you get down here, it's like, oh, where's the tax benefit? These are lower, relatively lower expenses. Here, up prior there, these are higher, right? So are we really getting a tax benefit? Yeah, for the first couple of years. So, but is that a justification for using double declining balance? No, because eventually it swaps out, right? Eventually straight line has a greater expense than double declining balance. So it's just something to be aware of, that tax reasons is a consideration. Let's see here. Some other concerns why you would use double declining balance is because things wear out pretty quickly. As things get old, you start losing functionality, right? As you know, you sort of, it's tough getting old because, hey, as you get older, you start losing, let's just say, your hair, right? And so you become potentially less attractive, maybe more menacing looking or something like that, right? So there are different ways of doing the double declining balance. Some people use, double declining balance is 200% or two times the straight line rate. Some use maybe like a 1.5, not a double, but a 1.5 declining balance. Other companies may use straight line. Just depends on whatever's easiest. Just be aware of that. It's difficult to predict gains and losses on asset disposal and sale, which sort of brings us into some of the concerns we'll talk about here in a second. First and foremost, what if we have a partial year's worth of depreciation? So realize that assets are usually bought and sold during the year, not the beginning of the year, right? So assume that FedEx purchases a warehouse building on September 1st and their fiscal year end is May 31st. Well, draw a timeline, right? Save yourself some frustration by drawing a timeline, okay? If we buy it September 1st and then go all the way to May 1st, right? How many months worth of depreciation are we going to recognize? It's actually going to be 9/12. And so if we go through and do our straight line calculation, 20 years, depreciable base divided by straight line, 20 years, gets us $21,000 per year. Make sure be careful on this. This is a great exam question. You always see this on the exam, right? Partial years depreciation, we're going to do 9 of the 12ths, and this 5250, that's 3/12 times the $21,000, right? So how we do depreciation can depend on when we buy it during the year. That's really only an issue for the first year and last year of its use. Second year of use, usually it's not too much of a problem. Other concerns about depreciation, here's a big one. Always see this one on the exam. What if we change our estimate? Remember, these are all guesses, right? So what if we find out new information as we're using this thing? So assume that we buy a vehicle, it costs us $50,000. We plan to use it for 10 years. We'll just scrap it. So I'm going to take the depreciable base and spread it out over 10 years. Fine. Every year, we're going to get $5,000 worth of use out of the truck. But then as we're driving it, we're starting to realize, hey, you know what? This thing's got a lot of durability. And we find out at the end of the fourth year, the car has an additional 12 years worth of use. So if we're right here, we're saying, hey, this thing is not going to stop at the end of the 10th year. It's actually going to go all the way to the 16th year. So it has an actual life of 16 years, not 10. And that can happen. That's normal, right? We drive things, we realize, oh, we sort of underestimated its durability, its strength. So we can make a change, but the calculations are a little bit tricky. How do we deal with that stuff? Well, we need to change our accounting estimate based on this new information. First, determine the net book value at the end of that year. So we determine at the end of the fourth year, we got a little bit more we can get out of this thing. So draw a timeline. Can't emphasize that enough, right? The thing was 50,000. We depreciate $5,000 per year. Multiply it times 4 years. Our accumulated depreciation at the end of year 4, right, is 20,000. Right? We've taken 4 years worth of depreciation. So what's our net book value? This is end of year 4, beginning of year 5. We have $30,000 future value left. Future value left. Okay. Now, we have some new information. we were going to use this for another, what was it? We were going to use this for another 1, 2, 3, 4, 5, 6 years. Actually, we're going to use it for 1, 2, 3, 4, 5, 6, 7, 8, 9. We're going to use it for 12 years. So what we need to do with this $30,000 is spread that out over 12 years. But we want to take into account any updates in residual value. So down below, I'm saying input any changes in residual value and estimated remaining, key phrase, remaining useful life. Assume in this case, there's no changes to residual value. We thought it was going to be 0. It's still going to be 0, even extra 6 years in the future. So remaining life is 12 years from the end of the year 4. Again, be careful. Be careful when you do these calculations. Don't miss points on this. We are right here. We're looking ahead and saying 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we take the 30,000, subtract off a 0 residual value. That's still the same. So the depreciable base is $30,000. So we're going to spread now over 12 years. So essentially we're going to do 6 more years. Now we're saying actually 12 more years. So we have double the years left. So 2,500 is my new depreciation per year. It was 55,000. Now it's gone down to 2,500. Does that make sense? Well, yeah, we're spreading it over a longer period. So it's a thinner spread of cost per year. And I have a little visual down below. We can take a look at this. So when we're recording depreciation expense years 5 through 16, this is our new life now, right? 12 years remaining. We want to make sure that we're using the 2,500 in our depreciation expense. Don't use the previous years. A lot of people miss that. Again, grade exam problem. Right, so make sure you know how to do that calculation. So this is a visual representation. Estimated life was 10 years. So recall that for the first 4 years, we're doing 1, 2, 3, 4. We're doing 5,000 a click. So 5,000, 5,000, 5,000. Then we stop and we say new adjustment. Let's make it 25, 25, 25, and we go all the way through, right? Total value, the sum of this, is still going to be the 50,000, right? That's the total depreciable base, right? So that will still sum up to $50,000, which essentially is like this. Imagine this is kind of like peanut butter. Right? We start spreading it across the bread. We thought it was going to end here, but now we're saying, oh, we got a lot more bread to spread this. So we can just stop and spread it thinner. This is thicker. So kind of think about the update in depreciation estimates as just spreading things thinly. If we have more, if it's the opposite, if we do shrink it the opposite way, we have like maybe only 2 years left of life, we want to make it thicker, right? It just sort of depends on which way we want to go. But I think a good visual representation helps sort of before you do the calculation. So I always tend to draw it out, sketch it out in a way that makes sense. I'm a visual person. What can I say? Fully depreciated asset. When assets are done depreciating, what do? Well, we don't record any more depreciation. That's the key thing. So if the cost basis is 60 and there's a 0 residual value, then by the time it's all used up, there should be essentially a net book value of 0, right? We don't keep depreciating it. We can still use it, but we don't depreciate it, right? Essentially means that we've taken all the value out of it. Whatever value is left over is probably not going to help us very much. It just essentially is worth 0. But those are all the notes I have for 7.3. I know it's a bit of a dense chapter, but if you do have any questions, please let me know.